Most Americans have their IRA and retirement accounts invested in stock index funds with the idea that they're going to grow with the market and they'll be able to withdraw income when they retire. In this video, I'm going to show you the simple but really critical secret about investing that very few people understand until it's too late. And the expert investment advisors don't want you to figure it out. Now, before I got started in real estate, I spent years in the securities business. And I can tell you that stockbrokers, investment advisors, fund managers, they could tell you this, but they won't. And if, like most people, you accept the standard retirement investment strategies that these experts are going to recommend, you'll be in for some major disappointments in your retirement years. So stay tuned and please hit the like button. One warning, there's going to be a little bit of math here, but we're going to keep it very simple, okay? Now, people are attracted to the stock market by these huge 20, 30% gains that the market has made during the good years, right? And investment advisors are going to show you a picture like this. Now, this is the image that investment companies are selling. And I see ads saying, hey, if you have a $500,000 or $1 million portfolio, contact our investment firm, right? The idea of this marketing is to get people to send them their retirement accounts, regardless of size, so that they can manage it, right? And for this, they earn a management fee, often between 1% and 3% per year, plus other fees for different services, right? Now, the more money these companies collect to manage, and the longer they hold on to it, the more they make. That's the way it works, right? But you're about to see that the investment industry is selling you a dream that just does not work. And you'll learn why you need to seek out alternative investments if you want to be able to retire comfortably. Now, investing in stock funds for future income is the tried and true retirement strategy that expert financial advisors are going to tell you to rely on, right? People usually cite historical average returns in the S&P 500 of over 10% per year. So suppose you had $1 million portfolio and you're going to retire assuming that you're going to have maybe a 20-year retirement window and thinking that in retirement you're going to take out that 10% average earnings per year, or $100,000 per year to live on and still maintain your principal. And this is the type of scenario that most of these stock market experts would advise, right? And it seems like a reasonable assumption, and it's probably how most people look at their retirement nest egg. Unfortunately, in reality, this strategy just does not work. So here you see a chart of $1 million invested at 10% simple interest, and you see taking out that $100,000 a year. And then next to that, you see a chart with interest compounding annually. And you see the difference if you leave that interest in and it compounds, you see how much you'd add up there, right? So this strategy would work if you had some kind of savings account that paid simple interest of 10% per year, and then you could just take out the interest and still maintain your principal. But stock market investments are equity investments, and they just don't work that way. Yes, if you let your investment accumulate over your working years, it might make sense to expect this 10% per year average return. But as soon as you start to withdraw money regularly during your retirement years, this whole scenario changes. So rather than getting into complicated explanations, it's much simpler if we just look at some examples so you can kind of see for yourself how it works. So we know that historically the market trends up and average historical returns are over 10% annually, right? If we look at a few recent 20-year retirement windows, for example, if you take a look at this chart, you're going to see the returns can vary quite a bit depending on the 20-year window, right? So they go from 17.4% down to 6.4%. And the average of these is actually about 10.4%, not adjusted for inflation, right? which is what normally people will quote as average stock market returns. So at first glance, this strategy seems reasonable, unless, of course, your 20-year window turns out to be one of those with lower than average returns, in which case you could be in trouble right off the bat. And in today's world, maybe this is more likely than ever, but let's not even worry about that right now. Let's assume that your 20-year retirement window does produce average returns of over 10%. In the real world, the idea that you could just take out your 10% gains every year just does not work. And if you follow it, you're going to end up with dwindling income in your retirement years. Why? Though there are going to be some years where your returns will actually be considerably higher than the 10%, some years will actually be negative. And some years, the market could drop 20% or more. And this is where you run into trouble that just doesn't happen when you're talking about a simple interest account like we looked at before. So let's suppose you start out fine for the first couple of years. And then there's a tough year in the market and it drops 20%. So if you take a look at this chart, you can see that since 1950, the S&P index has declined 20% or more on actually 12 different occasions, and it's 13 now if you count the current one. And that's an average of once every 6 years. But the average of these declines was actually quite a bit larger than 20%. It was 33%. And the average length of these market declines was 342 days, so almost a whole year. So getting back to our example, if the market drops 20%, now your portfolio is worth only $800,000. And if you withdraw your $100,000, it's only $700,000. Now, even if it goes up 20% the next year, you're only back up to $840,000, and your 10% income going forward is only $84,000. But if the market takes longer to get back where it was, which again, if you remember, it's been a year on average almost, you may well need to take out money again, and that $700,000 may be even lower before it starts going back. That would leave your principal significantly lower. And now your 10% returns might be $60,000 or $70,000 a year. And if you're retired for 20 years, over that period, a sell-off like this is likely to happen 3 times, as we said. And actually, the average has been 33%, not 20%. So you can just imagine the results if you have 3 of these corrections and the average one is 33% over your retirement years. This means that if historical markets are any indication, you can count on your invested principal and your income dropping considerably during your retirement, while at the same time you're going to be losing a couple points to inflation every year. And this all adds up to be a losing proposition that's likely to leave you scraping by in your later years. That's why it's not a good idea to count on stock fund investments for your retirement income. And even if you own a business that's a cash cow, you need to diversify your investments into alternative investments like real estate. There's a link down below for another video, and it'll tell you about the best and most profitable way to invest in real estate without becoming a landlord.